Welcome to Trading Nation. I'm Mike Santoli. One of Wall Street's most dreaded technical indicators, the death cross, rearing its head in the 10-year yield today. And with Fed Chair Powell sounding more and more dovish on potential rate hikes this year, is this the beginning of a bigger slide in rates? Joined by Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors, and Mark Newton of Newton Advisors to discuss that a bit. Mark, let's just get to the chart work here. Is there relevance to a death cross when we're talking about a yield measurement right here? And what do you think? Where do you think we're headed with Treasuries?
You know, I've done a lot of study with this, Mike, over the last 10 years, and really it's about a coin flip. So it's very difficult to think that a death cross is happening and then yields should continue to fall in this case. It worked very well in 2011 and 2014, but it was really not as effective in 2015 and 17. And so, you know, my work shows, you know, yields have pulled back about 50 basis points in the last 3 to 4 months. It's been a fairly dramatic move. Sentiment now has been cut in half. We had very negative sentiment on Treasuries last October. Now we're at about negative 390,000 contracts short. So it's been trimmed quite a bit. We're getting near oversold in yields. I think the percentage of people that believe the economy is dropping off the cliff is certainly pretty widespread right now. And if anything, I think that's probably not as imminent. So I see downside for yields at right near 250. So very, very close to a bottom, I think, in yields. And we should start to turn back higher over the next 3 to 5 months. So I'd be looking to sell into Treasuries and think that this death cross actually could prove to be the opposite of what historically people say could happen.
Maybe a bit of a trap in that case. Chad, what do you think about the general yield picture, and how does that feed into your investment posture right now?
Yeah, so we've extended durations within our portfolio. We think that there's a global deceleration of growth, and that markdown is going to be much more than expectations. You could see it within the China trade data as well as within the German production numbers. So we think that the European economy as well is going to decelerate. So let's get to the United States. There's an inversion, a modest, albeit, in the belly of the curve. You're starting to see on the big ticket items a deceleration there as well. So we think that, of course, there's going to be a markdown within GDP far in excess of where traditional economists are. So we wouldn't be surprised to see a 225 handle on the 10-year over the course of the next 6 to 9 months. And we also believe that the Federal Reserve will be a jump ball this year if they're going to be lowering rates a year out. So we think that they're going to have to continue to walk towards that dovish policy, unfortunately, at this point in time.
All right. Well, we did have a sort of moderate inflation reading on Friday. It probably keeps this debate alive for a little while longer. Thanks, both of you guys, for joining us today. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.